Welcome to the deep dive. We're here to cut through all that noise in the tech world, help you stay informed, really stay ahead.
That's the goal.
So today we're digging into HCL Technologies, big global player. We're going to dissect their Q1 FY26 results.
Yep. Looking at the earnings call, the investor releases,
Yeah,
pulling out the important stuff.
exactly. We want to give you that shortcut. Understand where HCL stands, what their moves mean for, well, everyone else in tech.
Right. So the mission today, get you a clear picture. Financial health, operations, and yeah, those big bets they're making, especially on AI.
We'll look at the numbers, sure, but also the story behind them. Try and figure out what it means for you listening.
Let's jump in then.
Okay, let's unpack this. The big picture first.
Yeah.
Overall revenue for Q1 FY26. HCL Tech reported, what was it, $3,545 million.
That's the one. Or about 30,349 crores in Indian rupees.
And the year-over-year growth in constant currency, so taking out exchange rate weirdness, that was pretty healthy, right? 3.7%.
Yeah, 3.7% year on year, which is solid. But sequentially, so quarter over quarter, it dipped slightly, down 0.8% in constant currency.
Okay, but Q1 is usually a bit softer for them, isn't it, historically?
It is, yeah. That sequential dip isn't a huge shock. But here's the thing I found really interesting.
Go.
Even with that small dip, their LTM revenue last 12 months crossed $14 billion. That's a big milestone.
Wow, $14 billion LTM. That definitely signals something more than just one quarter's numbers. Shows some real scale and consistency, maybe?
I think so. It shows they can keep landing those large multi-year deals even when the market's a bit shaky. Sets them apart from smaller players. It's proof of that underlying strength.
Okay. Now, profitability, margins. This is where it gets juicy, strategy-wise. Operating margin was 16.3%, lower than planned, they said.
It was. EBIT, so earnings before interest and taxes, that came in at $578 million.
And net income?
$440 million, which works out to 12.7% of revenue.
So why the dip? Why lower than planned margins? What happened there?
Well, they flagged three main reasons. First, utilization took a hit.
Utilization meaning how many of their employees were actively working on billable projects.
Exactly. And it wasn't random. They actually ramped up hiring in March, building capacity, getting people with specialized skills ready for a big deal.
Ah, okay.
That deal's taking a bit longer to ramp up fully.
Huh.
And then they also had some ramp downs, like in the auto sector.
So less work from some existing clients.
Right. And combine that with people getting freed up because of productivity gains. But they couldn't just slot them into new roles, mismatches in skills or location.
Like having the right players but for the wrong game or in the wrong city? Got it.
Yeah, that's a good way to put it, a real resource puzzle.
Okay, that's one factor. What else?
Second was, unfortunately, a client bankruptcy. Just a one-off impact, but it definitely hurts the bottom line when it happens.
Ouch. Never good. And the third factor.
The third one was, well, strategic. They actually chose to accelerate their Gen AI investments, pulled forward spending on AI platforms and efforts.
So they consciously decided to spend more on AI now, even knowing it would hit margins in the short term.
Seems like it. A deliberate trade-off, betting on long-term AI leadership over immediate profit maximization this quarter.
That's a bold move. Suggests they feel pretty confident about the underlying business, though. I saw their LTM return on invested capital, ROIC, is still strong.
Oh, absolutely. The company ROIC is 38.1%. That's up 353 basis points year over year.
And for the services part?
Even better, 45.2%, up 236 basis points. Those numbers definitely show the core business is efficient and generating good returns on the capital they invest.
Right. And what about shareholder returns, EPS?
Dividends.
Diluted EPS for Q1 was $1.17, or INR 14.1 cents, and they declared another dividend, INR 12 per share.
Is that consecutive?
Yep, 90th consecutive quarter paying a dividend. And the payout over the last 12 months was like 95.8% of net income. Shows real commitment to returning cash to shareholders. Signals stability. Okay, so financials paint a picture of, well, solid top-line growth overall, but some margin pressure due to investments in specific issues. How did things look operationally? Different business lines.
Let's break that down. The main engine, the services business, actually grew pretty well, 4.5% year on year in constant currency.
Despite that slight sequential dip of 0.1%.
Exactly.
Yeah.
Which, like we said, Q1 seasonality, it suggests their all-weather portfolio idea is having a mix of services that holds up decently across different conditions.
And within services.
IT and business services grew 3% year on year. Solid. But the real star was engineering and R&D services. That was up 11.8% year-on-year. Huge growth there.
Nearly 12%. That really highlights the demand for that specialized engineering stuff, doesn't it?
Definitely. Clients need that innovation edge. Now, HCL Software, that was the weaker spot this quarter.
Yeah, down 3% year-on-year, constant currency. Should we be worried there?
Well, it's worth watching, but maybe not panicking just yet. Here's the nuance. While the overall revenue was down, their ARR, annual recurring revenue, actually went up.
ARR, so the predictable subscription income.
Exactly. That increased 1.3% year-on-year, hitting $1.06 billion. So even if one-time license sales were down, that growing recurring base is a good sign for their shift towards more subscription and SaaS models.
Okay, so maybe a transition rather than a collapse makes sense. What about where the business came from geographically?
Geographically, rest of the world was the leader, up 15% year-on-year, big jump. Europe was also strong, 9.6%.
And the U.S., India?
U.S. grew just 0.5%, so pretty flat. India up 1.3%.
Interesting mix. And verticals. Which industries are driving growth?
Top performers were tech and services, up 13.7%. Telecom and media also strong at 13%. Then you had retail CPG at 8.2%, and financial services at 6.8%.
Okay, so financial services and tech are still chugging along, but you mentioned some stress earlier. Manufacturing, life sciences.
Yeah, management specifically called out manufacturing, particularly the auto sector, as being under pressure. Also some stress noted in life sciences and parts of retail and CPG.
So maybe different demand cycles hitting those industries, or just more caution on spending.
Seems like it. Could be a mix of both.
Hmm.
Compared to finance and tech, they might just be tighter with the purse strings right now.
But even with that stress, they're still adding big clients.
Yeah, healthy additions. 6 new $50 million plus clients year-on-year, 11 new $20 million plus clients, and net new bookings were $1.8 billion for the quarter. Solid number.
$1.8 billion. Not bad.
Plus, they won a big consolidation deal in financial services where a client brings all their IT work under one roof with HCL Tech. And that win wasn't even counted in the Q1 booking number.
Oh, interesting. So the pipeline looks decent.
Seems so. They also mentioned 2 other large deals they expected in Q1 got pushed to Q2. Apparently just procedural stuff, internal client delays, not market issues. They seem pretty optimistic those will close.
Okay. So overall, the sales engine seems to be working, balancing out the portfolio with digital and engineering wins.
Yeah, that seems to be the picture.
Now, let's shift gears hard to AI, because it feels like that's becoming absolutely central for HCL Tech, doesn't it?
Oh, definitely. You hear it threaded through almost everything now. Their digital business wins are increasingly driven by engineering and, crucially, client belief in their AI capabilities.
They mentioned doubling down on modernizing applications by building AI right into the core and that AI data lifecycle platform.
Yep, AI and Gen AI are just becoming standard parts of the conversation in almost every deal. And you mentioned agentic AI earlier.
Right, where the AI isn't just generating stuff, but actually doing stuff, planning, executing tasks.
Exactly. That's gaining traction. HCL Tech seems to be pursuing AI very strategically across like 3 dimensions.
Okay, lay them out for us. Dimension 1.
The ecosystem. Partnerships. They made a big splash announcing a strategic partnership with OpenAI, one of the first service providers to get that kind of tie-up for enterprise AI.
OpenAI, wow. Who else?
Key partnerships also with UiPath. That's for the agentic automation piece. Google Cloud, again for agentic AI solutions. And NVIDIA integrating their AI enterprise, AI Force platform, Omniverse. The whole stack.
So they're building a network, not just relying on one tech. Smart. Dimension 2?
Their own offerings. They're claiming they were first to launch a full-stack AI portfolio. Things like AI Force, AI for Foundry, AI Labs, AI Engineering.
Is AI Force the one getting deployed already?
Yeah, that's the one. Already rolled out to 35 clients, over 70 deployments, they said, and it's helping them win new deals. So it's not just slideware, it's being used.
Okay, strong ecosystem, actual offerings. Dimension 3 must be clients actually using it, client engagement.
Precisely. And they're saying the deals are getting bigger, moving beyond just small proof of concepts or POCs into real strategic multi-million-dollar partnerships focused on AI.
Got any examples?
Yeah, they gave a few. A multi-million-dollar deal with an Aussie logistics company, using AI Force for service transformation, optimizing operations. Right. A European telecom firm using Gene AI and AI Force for zero-touch operations, basically automating network management.
Ambitious.
A global sports body building a Gen AI commentary platform. Imagine that. Real-time AI commentary.
That's wild.
An aerospace company using Vision AI for cargo optimization. A Japanese imaging company using Gen AI to recommend camera settings. Real, tangible stuff across different industries.
That really shows the breadth. Okay, so they're betting big on AI, tech, and partnerships. What about the people side, the talent needed for all this?
Right, the talent strategy. Headcount actually dipped slightly, down 269 people. LTM voluntary attrition was 12.8%, pretty much the same as last year.
But they're still hiring.
Yeah, added almost 2,000 freshers, 1,984.
Yeah.
But it sounds like a very targeted approach, focused on specialization. And they mentioned re-indexing compensation for elite and software specialists.
Meaning paying significantly more for top AI and software talent.
Seems like it. Up to 3 or 4 times base compensation, they hinted. Really trying to attract and retain those key skills needed for the AI push. Trying to solve that skills mismatch puzzle we talked about earlier.
And they mentioned restructuring, too.
A broader program, hitting both people and non-people costs. The stated goal is structural agility for the AI era. Basically, making the organization more flexible to respond to how AI is changing demand, like we saw with auto, and making sure they can deploy people effectively as AI creates productivity gains.
Reshaping the company for the future makes sense. And it looks like clients are noticing the overall effort. That Gartner recognition sounded impressive.
Yeah, being named Customer's Choice in all 6 Gartner Voice of the Customer quadrants for IT services. That's apparently a first for any service provider.
All 6? What does that really tell us, more than just a nice badge?
I think it speaks volumes. It suggests really consistent delivery and high client satisfaction across the board, different service lines, different types of work. Not just good at one thing, but broadly trusted by clients. It points to strong operations and a real customer focus.
Plus, the other awards, Asia's Most Honored Exec Team, Microsoft Responsible AI, AWS Gen AI League, Forbes Best Employers for New Grads, adds up to a picture of a company performing well on multiple fronts.
Definitely. It paints a pretty comprehensive picture of recognition.
Okay, so let's look ahead. Guidance for the rest of FY26. They revised it, right?
They did. Revenue growth guidance was actually bumped up slightly. Now expecting 3% to 5% year-on-year in constant currency.
Yeah.
Based on Q1 and the outlook, they feel a bit more optimistic on revenue.
But the margin guidance came down.
Yeah, EBIT margin adjusted to 17% to 18%.
Yeah.
And that ties back directly to those Q1 impacts, the utilization dip, the bankruptcy, some of which they expect to linger into Q2.
Plus the accelerated spending.
Exactly. Those bigger investments in sales, marketing, and especially AI. And the one-off costs from the restructuring program all factored into that revised margin range.
But management sounds confident they can hit these new targets.
Yeah, they expressed optimism, pointing to the revenue outlook, the booking trends. They seem comfortable with the revised guidance, despite the near-term margin pressure. It's a calculated move.
It really feels like they're navigating this art of the possible with AI, as they put it, showing clients how AI can optimize things, save money.
Even if it means a bit less revenue from that specific area initially. This idea of AI causing deflation in some services.
Right. Like you mentioned potential benefits, 25–30% in the software development lifecycle, maybe 40–50% in things like contact centers, potentially cutting headcount needs by like 75%. That sounds like it could shrink the market.
It could shrink parts of the market, yes. That's the deflationary pressure.
Right.
But here's the counter-argument they seem to be banking on.
Which is
that same efficiency push frees up client budgets and creates urgency to modernize everything else, especially legacy applications that weren't built for AI. So AI drives new demand even as it makes old tasks cheaper.
a push-pull effect. Deflation in one area, new demand in another.
Exactly. And they gave that stat. 8 out of 9 recent client renewals actually saw increased total revenue after HCL Tech helped them find AI-driven savings.
So helping clients save money actually led to them spending more overall with HCL Tech.
That's the strategy in action. Trade some savings for the client now, build trust, showcase capability, and win a bigger slice of their overall tech spend long term. It seems to be working based on that example.
Okay, so wrapping this up, what's the key takeaway for our listener from HCL Tech's Q1?
I'd say it's a picture of strategic navigation, solid revenue growth overall, driven by services, weathering some bumps. But the big story is the very clear, very deep commitment to investing in AI.
Even at the cost of some short-term profit margin, they're making a deliberate bet on the future.
Absolutely. And they're actively restructuring, adapting talent, chasing those AI partnerships, really trying to position themselves to lead, not just follow, in this AI transformation.
It's not just reacting, it's trying to orchestrate their future.
Well put. They're willing to accept some short-term pain in profitability, as they phrase it, to try and secure long-term growth leadership.
Which leaves us with that final thought for you, the listener, to chew on. In this age where AI is changing everything so fast, how do companies like HCL Tech keep balancing today's profits with tomorrow's massive AI investments?
hmm And what does HCL Tech's willingness to make these tough trade-offs tell us about where the whole IT services industry might be headed?
What questions does it raise for you about how technology is fundamentally reshaping business itself? Something to think about.